Hi there, Bruce Salik from Guaranteed Rate. How are you?
Hey Jackie, what's going on?
I'm
How's
so glad we were
everything?
able. What?
How's everything?
I was actually sick the first couple of weeks of January, so I got a little bit of a slow start. Um, but I'm better. My voice is still a little hoarse, but I'm 100% now. Oh my God, it took me a little long to recover.
Well, good to hear you're okay. Let's kind of kick off 2024 with a bang, okay?
Yes, absolutely, absolutely. So thank you so much, Bruce. Can you talk a little bit about yourself?
Sure. I'm Bruce Salik. I'm with Guaranteed Rate, almost 6 years. I've been in the mortgage business for over 30 years. I absolutely love what I do. It's the most gratifying thing to get um, people into homes and achieve, their dream of home ownership. Passionate about the business. I try to make myself available to my agent partners and to my clients whenever they need me, nights, weekends, whenever. And that's pretty much how I do my business.
Yeah, and I can definitely attest to that. That's for sure. You're always available for my clients, so I definitely greatly appreciate that.
Thank you. Appreciate it.
So there's so much going on in the market. I mean, so much talk about 2024, presidential election year. I mean, there's just so much. What are you I know the biggest question everybody asks is, are the rates going to go down? And how far do you think they're going to go down?
So, just looking back over the last 2 years, the Fed hiked rates 11 times. Um, rates were pushing 8% in October. And all the Fed hikes, which were put in place to tame inflation, finally started to work. Inflation became under control, and when rates were hitting 8%, and we heard clients, "Hey, I'm not in at 8%. I need rates to go down." Rates started to go down as the Fed um, gave indications that they're going to start cutting rates this year. And right now, there's about three rate cuts priced in. Some feel it's going to happen as early as March. I think it'll probably start happening in June or uh, July when that starts to happen. But
Hmm.
since the highs of October, rates have dropped from like 8% to 6.5%. And it was a little bit lower. Rates have been moving a little bit against us over the last couple of days, but still much lower than where it was before. I'll give you an idea what that means, Jackie, to our buyers. Like
Hmm.
if you were buying back in October at 8% on a $500,000 loan, that
Yeah,
payment was about 3668 without taxes. And
right.
today it's about 3160. So a buyer today versus the end of October is saving over $500 a month on a $500,000 loan, and that's the equivalent of like $80,000 in buying power. So if you have a buyer that max qualifications back in October was 600,000,
Hmm.
today it's to 680. So buying power is up, making it a great time for our buyers to get back out there.
Right. And it's been challenging for some buyers to get their offers accepted. As we all know, it's very competitive, it's very low inventory. So, what are some of the things that you've been doing and I know you've helped a few of my clients, but what are some of the things you're doing to make people's offer? And of course, not every offer is going to get accepted. We have to go through a couple, but what are you doing differently to make your offer stand out more?
I mean, first off, we have a very good reputation in our area. So a pre-approval from a local known lender does go further than one that's not known or one from the internet. Um, and there's a handful of us local that have great reputations that can help a deal get accepted. But we're trying to put our clients in the best position to win their offer. So we're talking to them about, trying to put down a little bit more so their offer stands out. If they can, if they only have limited funds and they can only do a 3 or 5% down, so be it. And that's what they have to go in with. But we're
Hmm.
talking to our clients about potentially a little bit bigger down payments, maybe accessing 401ks or getting gifts for a stronger down payment, because usually it's not to say that low down payments don't get accepted, but clearly if you're in a competitive offer, the bigger the down payment, the better you're going to be. Also, waiving your appraisal contingency. Unfortunately, a lot of our buyers have to do it, which means they buy the house regardless of where the house appraises.
Mhm.
And we talk to them about what that means, what it means to do it, and what the house would have to appraise at in order for them not to put extra cash in.
Mhm.
So it's things like that where we're really prepping our clients up front. We're also giving them a breakdown of costs and payments so they know exactly what their closing costs are. A lot of our
Mhm.
competition doesn't do that, but we're really prepping our clients and making them prepared to put their offer in the best position to win.
Yeah, and I think we're really good about like coaching the clients, just kind of getting them prepared as they enter the market. I do find that the appraisal always kind of gets to be a little bit of a sticky situation. Can you give kind of like a little bit of an example of, when a buyer, when the house doesn't appraise, like what have been some of the coaching that you've done with clients on that respect? Because I think when people see, oh my God, it appraised for less than what I offered, it's kind of like a little bit psychological, and they tend to think, well, I don't want to pay more, but the market is that way. We're paying more than than list price most times. So what kind of things have you been able to, coach clients on that?
All right, Jackie, I'm going to knock wood here because we haven't missed an appraisal yet since COVID.
Yeah.
So we have not come in short. And that's why, we have the reputation, because we haven't missed an appraisal yet. But when we talk to a client about potentially waiving their contingency, um,
Yeah.
we talk to them like, hey, you're going to be the first one to miss because we have to talk like your house is not going to appraise. So, for example, if somebody's putting down like 20%,
Right.
okay, and their price is 500,000, let's say, and they're financing 400,000, that's 80%. So what we do is we talk to them about what the house has to appraise at. And frankly, you know, we can go up to 95% financing here. So the house has 15% room to come up short. So it doesn't have to appraise at 500,000. And if it didn't, they could just take a loan with PMI, which would add a couple of bucks, maybe $50 a month to their payment, depending on where it came in at. But it's not like they have to come up with the difference, which is what people think when the house appraises short. Hey, I got to come up with more money. You could just take a loan with a higher payment with PMI. Like if you're at max financing at, let's say, 95%
Right.
financing, and the house comes up short, you're going to have to cover the difference. And you may not be the best candidate to waive your appraisal contingency. But
Mhm.
we had a client with you that we qualified last year that we talked about, hey, he was going to put down 5%. And we talked about, his getting a gift if the house appraised short. And he
Right.
did go in with some offers where he was able to waive his contingency. So that was something, look, it has to be the right circumstance, and not
Right.
everybody can waive their contingency. But if you're not at max financing, there's a good chance you can waive your contingency.
Okay, that's good. Yeah, that definitely made a difference when we had that conversation with him. I
Yep.
think he was able to really be a little bit more competitive in his offer. And it just ended up working out. So that was really good. So actually, now that you're talking about um, buyer's approach, what are some of, I guess there's like some new products that have come out on the market for either first time home buyers or
Yeah, so we have a couple of programs. There's two I'm going to talk to you about specifically. One is just a regular first-time homebuyer program. First-time homebuyer is defined as somebody who has not owned a home in the last 3 years.
okay.
Okay. Um, in the Rockland County, Bergen County areas, the income limits for this program are $139,560. Okay. In Orange County, it's a little higher, it's a little over 140. But if you can keep your first time home buyers income under that, you get better rates. Okay.
Oh,
So yesterday I qualified somebody and the couple made $200,000.
Right.
Okay. And the husband made 130 under the limits and the wife made 70. So what I did was I creatively qualified them, didn't take the wife off, but just left her income off the application so I can
Mm,
keep her in the first time home buyer program. And what we call it AMI, which stands for area median income. Our AMI first time home buyer product gives you better rates if you could stay under those loan limits. So when their rate was about 6.8% combined, because they were over the limit, when we were able to get them under, we were able to give them a rate of about 6.5%. So this product will give you the best possible rate. So if your credit score is 620, okay, and you're not in the first time homebuyer program, you could get a rate in the mid to upper sevens. But if you fit in the first time homebuyer program, you'll get a rate around 6.5, which when you fit in this program, it takes away all the overlays of credit add-ons and high loan to value add-ons. It just gives you better terms. So we're always trying to get somebody qualified in this program if we can. That's not to say that if we're not going to jeopardize their qualifications, we're going to, like, if they have to show all their income and it's over the limits and they want a house that's, they need every bit of income and it's 200,000, they'll lose the first time home buyer program. So be it. But when we have the opportunity, we try to keep them in that first time home buyer program under those income limits, if that makes sense. So
yes.
we're creatively qualifying as many clients as we can. Another example is if a client makes like 150 and 20 of that is bonus, and we don't need that to qualify, we can leave that off the application,
Oh,
keeping that
interesting.
income under, that 140 limit we need to be at. So
Okay.
yeah, so that's a program we're trying to qualify everybody at. Um, Here's our hot new program. Okay. So this is a huge one. So at in December, we were one of the handful of lenders that's working with Fannie Mae nationally. And when I say handful, probably less than 10. Okay.
Right.
So we're able to offer what's called a special purpose credit program, which is abbreviated SPCP, which I'm going to refer to that a decent amount. This product allows us to give our clients a grant for $8,000. Now it's not a something that has to pay back. It's not a forgivable second like the Sony May loans. There's no recapture tax. It's here's your money. Fannie Mae is encouraging, they want to help people buy homes. They want to give money away, and we're happy to do that. The way it works is 5,000 of it comes from Fannie Mae, and
Right.
up to 3,000 comes from guaranteed rate, or up to 1% of your loan amount, or $3,000, whichever is lower. Okay, so the way to qualify for this is you have to be a first-time home buyer.
Yes.
Okay. You could do as little as 3% down. You have reduced PMI. Now, the catch to this deal is the buyer must reside in a specific census tract area to be eligible. They have to live in it. Okay. They don't have to buy in it. They can buy anywhere, but as long as they live in this specific census tract area, they are eligible for this $8,000 grant, regardless of their income. So there are no income restrictions.
So when you say, can you clarify what you mean by census tract?
Yeah, so Fannie Mae has coded certain areas as specific census tract areas. I'll give you an example in Rockland County. I've looked up pretty much every town, and most of West Haverstraw, Gardnerville are all areas where if you reside in those areas, and again, Jackie, if you have somebody specific or somebody specific, run it by me. I could put them in our map and see if they qualify for that. But if they do, regardless of income, they qualify for the $8,000 grant. Now, all I need is one of the homeowners not one of the buyers not to be a home, not to not to own in the last 3 years to be eligible.
Okay.
So if I had a couple and the wife owned a house 2 years ago, but doesn't own it now, and the husband never owned, we could do this SPCP program. So we're literally,
Hmm.
Jackie, giving money away. So
That's wonderful.
yes,
Now,
absolutely.
you're the only one?
Well, I can't
Oh,
say we're the only one. I just know that
right.
there's a handful of lenders with Fannie Mae doing it, so I don't want to represent that. But
Okay.
we're one of a few lenders that are doing this program with Fannie Mae.
That's awesome. That's so great to hear. And like you guys are always like creative and innovative in your creative financing, always staying ahead, kind of
Absolutely.
anticipating what what buyers need to get, to make their dreams come true, right? So you
Yeah,
guys are definitely always good about that.
we
So,
want
um,
we want to promote home ownership. What better way than give money away, right? Come
no.
on.
Well, I'm looking for a house too. So this is the year. Last year, listen, just like everyone else, um, you know, didn't work out. But this year we'll definitely make it happen.
Great. Well, I'm ready to help you when
Yes,
you
absolutely, absolutely. So I know you talked a little bit about credit. So I just kind of want to go over some of the questions that a lot of first-time home buyers have.
sure.
Um, what is a general percentage like we can estimate and tell, like somebody says, what are the closing costs going to be? Like, what is the general percentage we can, give them? Would be 6% of the sale price, just so that, they can get an idea in Bergen
I
and
think
Rockland, since
Yeah,
those are my markets.
I think in, look, in Rockland County and Orange County, taxes are due once a year. You got to come up with the full year of taxes.
Hmm.
And like I say, when we speak to a client, pre-approve them, we send them a breakdown of costs and payments. A lot of our competition doesn't do that. We want our
Yes.
clients to know what a line by line look at all the costs look like on a transaction. So we break those out. But just as a general rule, and again, it's probably between 5.5% to 6% in
Okay.
New York, probably 3 to 4 in New Jersey, because taxes are due less frequently in New Jersey, and there's no mortgage tax in New Jersey. So it makes things a little bit cheaper from a closing cost point of view in New Jersey.
Right. Right. So, in terms of some misconceptions and some myths that I like to say, um, you don't need 20% to buy a house. Obviously, you mentioned it before, but for people that, always think that you have to have 20%, you don't have to have 20%.
Correct. I mean, we get that a lot. Oh, I have to put down 20%. I was like, no, there's so many options for you with 3%, with 5% down. So, like we talked about before, you're going to need mortgage insurance. But,
Hmm.
mortgage insurance is so much cheaper than it was years ago when it was a lot more expensive. If you have a good credit score, it could be only, 50, $60 a month. So taking mortgage insurance is not the worst thing in the world, especially like people come to us, like you say, they think they have to put down 20% and they strive for it. But we don't want our clients to put down the 20% if it's going to jeopardize their savings, meaning that it's every last penny they have. We'd rather a client put down 10 or 15% and have some money left over in reserves for a rainy day. God forbid
Right.
they need repairs or they want to furnish or improve the home. They have the extra funds to do so. So yeah, 20% definitely doesn't have to be put down. Could be
Right.
much less than that, assuming the
Right.
client's comfortable with the payments.
And what about, okay, so the other question is, I have bad credit. Can I buy a house?
Um, well, look, some of our loan programs go down to 560 on credit score, but that would be for an FHA loan, and there's a lot of overlays when you're in the 560, 580 range. But, we have programs for just about all credit. Um, look, if you could fit in the first time homebuyer program and your credit's not perfect, you get the same rates at 620 as 680. But, there are FHA loans that can give pretty good rates. They're around 6% today. But yeah, look, you have to qualify on paper. You have to have enough income to pay it back. But assuming you do and you have the assets to close, your credit doesn't have to be perfect to buy a home.
And I know one of the things that you do is even if a person may have challenge with credit, at least you put them like on a plan and say, look, maybe you can pay this off so that in the next 6 months, we'll be in a bit of a different situation. I know you've done that as well. You kind of put somebody on a plan to build their credit back up again.
Yeah, our credit, like with our credit companies that we work with,
Hmm.
they give us the tools to simulate. So in the
Yeah.
past, you used to have to do these credit repairs, and I'm not saying we do credit repair, we don't. But
Right.
in the past, credit repair companies, you'd have to pay thousands of dollars for, pay by account. We can now just simulate things and say, okay, if you paid this, and this down, your credit score would go from 620 to 700. Okay,
Right.
so there are true simulations that we can do.
Right.
Now, you didn't ask about this, Jackie, but I'm going to tell you about it. So
Okay.
all our pre-approvals now that come in, all our initial applications, we've switched from a hard pull credit to a soft pull credit. So clients are always concerned about, hey, I don't want my credit run, I don't want to get a hard hit. Our initial inquiry now is soft. So what a soft pull does is it doesn't lock down your score, but it does give you three accurate scores. And it would be, if we lock down the scores that day with a hard pull, it would be the same exact scores. But the reason why we're doing the soft pull is a lot of clients are resisting the hard pull up front. So they don't want their credit hit yet. And look, if the credit is marginal and the pre-approval is kind of on the fence, I'll recommend doing the hard pull, just because if the score changes a couple of weeks later, it could impact that pre-approval, and we don't want that.
Right.
But the beauty of the soft pull is we do it up front. And like you said, we could do this simulation and tell them, what they need to do to qualify for the loan with credit. Or if their credit maybe is 700 on the initial soft pull, we could tell them, hey, pay this, and this off, and your score will go to 760. And then your rate will be a quarter to three-eighths better.
Right.
So soft pull is pretty powerful right now. And we're able to engage with more customers because many customers don't want the hard pull. That's not to say it's not necessary at times.
Right.
When we don't have to do it, we're not doing it. We're doing the soft pull.
Got it. Got it. And I was going to ask that question about credit pulse.
I beat you to it.
Yes, you
I
did.
knew you were
That's
going there. I
that
knew it.
that is another, we get asked that all the time, is my credit going to get impacted but thank you for definitely talking about that. So as we wrap up here, I'm just going to ask you a couple more questions.
Sure.
So you have been in the market mortgage industry for a very long time, and you have seen so many different markets. This is a very this is a very intense couple years we've had. We're in a presidential year. Um, how do these types of events like this presidential affect, market that you've seen in the past?
I mean, look, it used to be that rates stay low in an election year, but I've seen enough of them. Yes, I'm older. I'm not going to say old, I'm going to say older. You just never know what's going to
Yeah.
happen. We just have to look at the economic trends.
Yes.
And right now, we're fighting inflation.
Mhm.
Assuming inflation stays low and jobs don't grow at such a rapid pace, rates are going to stay low. The Federal Reserve is going to potentially cut rates numerous times this year. A lot of that's priced in already. And like I said, I think it's going to happen mid-year. But, look, don't quote me on it, but I'm hoping to see in the last quarter potentially rates that start in the fives versus in the sixes. And we've come a long way from sevens and eights of last year. So, hopefully rates will be a bit lower later in the year. Look, a couple of years ago, we had a gift 2-3%. I don't think that's coming anytime soon, but I do think fives are potentially doable. And I think it's, as rates fall, I think you're going to see some sellers list more because, now instead of going from 3 or 4% rates to 7 and 8, they're going from 2, 3, and 4 to maybe 5 and 6, which is a little bit more
Right.
palatable. So I think for our buyers out there, hopefully as rates fall, there'll be a little bit more inventory
Right,
for our buyers.
right. So what advice do you have for closing thoughts? So what advice with this competitive, market, what advice do you give to our buyers in 2024?
Just be prepared. So, and what I mean by that is, look, hopefully you'll come to me for your pre-approval and your lender, but make sure you get closing costs up front. Make sure you're prepared. Make sure you know what your payments are, what your closing costs are, because in this market, you have to react fast. If you don't make a decision quickly, you're going to lose the house. And sometimes it takes one, two, or three homes to lose because you didn't act fast enough to realize this. But make sure your lender is going over those costs and payments right up front. Because if you're doing it in the 11th hour, it's hard to make a fast decision. So be prepared, get all the data up front, make sure your lender goes over every fee, all the closing costs with you, just so you're prepared to act quickly and win. It's all about winning, and we want our clients and our buyers to win in 2024.
Thank you so much, Bruce. I really appreciate it. It's always a pleasure to, chat about the market and what's going on. And thank you so much for, all that you did for my clients in the last few years. So I'm truly grateful for that.
Jackie, it's a pleasure working with you. And looking forward
Thank you.
to killing it this year with you.
Yes, absolutely. Absolutely. It's going to be a busy one. So thanks so much, Bruce.
All right, Jackie, we'll talk. Take care.
Bye.